Was really good, fam. It's been a minute since we talked macroeconomics, so today we're gonna do a big explainer on something that's becoming somewhat of a large-scale worry both here and abroad. You're watching Sekidor, and today we're talking about stagflation. Now before we continue, we'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. So for that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether taking up a position on any stock mentioned here is in your best interest. Want to know how? Well, if you scroll down a tiny bit, hit the like and subscribe buttons, we'll do our best to help you figure out this game for yourself. And that being said, let's get to it. Alright, so to start with the concept of stagflation, let's break it down into its component parts. The first half, stag, is a shorthand for the word stagnation, or a scenario of slow to no economic growth. The second half, predictably, refers to inflation. This refers to a progressive reduction in the relative purchasing power of a given currency. Now, inflation is something that we've talked about a lot in the past, and if you want to see what we've said about it, feel free to click in the link in the top right hand corner of the screen right now. Otherwise, we're going to take this opportunity to expand on what we already know about it. Now, in simplest terms, inflation is the rising of prices over time. While this may be true, the real-world effects of inflation may not even be felt in certain cases, and I'm going to draw an example of when inflation isn't felt as inflation based on these terms. Alright, now imagine we have a town called Fugazi. One morning, all of the citizens of the town wake up to find that all the prices of everything in their town have risen by 30%. That's 30% inflation. Miraculously, however, the amount of money in everyone's accounts has also risen by 30%. Every single person also received a 30% raise, and interest rates are, you guessed it, also 30% higher. Now, after the initial shock of finding their financial lives thrown for a loop, the people of Fugazi may soon realize that in spite of the changes to their financial reality, the functional value of their lucre hasn't actually changed at all. Herein lies the key confusion about inflation in the common conception of the phenomenon. The problem of inflation is not simply the rising of prices in a vacuum, but rather the decrease in the value of currency as it relates to a given person's ability to earn and spend it. In that way, inflation and the problems it brings with it in the real world are experienced differently by different people. That's really a different conversation than what we're going to be having right now, because if you look at the current economic indicators that we've mentioned in our October economic update, you'll see why the stag in stagflation is truly worrisome. And let's get to that half. So as we noticed, inflation is mostly relevant to those whose economic well-being doesn't adequately pace with the rising prices. Economic growth, then, is key to ensuring that inflation doesn't have sweeping effects across an entire economy. For if inflation is at 2%, but economic growth is at 2% or greater, and capital redistributions through both private and public avenues ensure that nobody falls behind, well then the effects of inflation are as blunted as bread and meth. However, a stagnant economy suggests little to no growth, which is problematic if the inflation rate doesn't also remain stagnant. So for example, imagine we're back in Fugazi, and although the prices of everything have gone up a cold 30%, everything else is showing little in the way of following along. In this case, prices go up, but wages and interest do not, which means that the ability to earn, as it relates to the majority of people, is lost, and it may be very difficult for them to afford a comfortable or even adequate life. Now, if government benefits don't make up for the failures of the private sector, then it wouldn't be out of the realm of possibility for the masses to take direct action and force the system to change. If you want to read more about the importance of capital redistribution in thriving economies, I recommend the book Good Economics for Hard Times by Banerjee and Duflo, though I do think they also have YouTube lectures. But anyway, it's definitely a good read. But this, in all, is the stagflation situation that we're seeing a lot of stress about in the news right now. Now, what's the foundation of these worries? Well, on top of the real-world inflation that we've experienced with increasing costs in food, transportation, gas, and shipping, economic indicators suggest a pullback in growth after exports peaked in the third quarter of this year. Looming stagflation in China, by far our largest trading partner, and supply issues like the semiconductor shortage reducing output in important sectors like automotive manufacturing have increased stagflation worries to the point where, well, let's just say I don't envy whoever will take over the reins in the upcoming election. Now this begs the question, what are our moves? Well, if you're like us, reducing or ceasing our investing behaviors is simply not an option because unless we see an economic revolution or change in the economic world order in the near future, then historical precedent dictates that times of slow growth are actually good buying opportunities. More importantly, however, is to keep in mind that a stagflationary environment necessarily means that whatever cash you're holding on to will be progressively devalued for the long run. And holding on to long-term cash as cash, such as in checkings or savings accounts, would be incredibly costly in the long run as well. Still, while the indicators aren't particularly encouraging at the moment, there's a chance that much of what we're experiencing right now is transitory and a direct result of our recent battle with the plague. Still, it would be prudent for anyone looking out for their own financial well-being in the ROK to be well aware of where we're at least in the short term, plan accordingly. There really are a bunch of different strategies for inflationary climates. One of them is to buy precious metals. Another one that we like to talk about and that we have talked about in the past is about buying REITs, which we'll link to in the top right hand corner right now. Often these strategies are based on the idea that non-financial assets, like tangible assets, don't inflate at the same rate and retain their own value, while cash and cash equivalents tend to lose their own value over time. Anyways, that's it for me. I'll be back with a quickness to talk more about what's going on in our market, but until then, be easy fam. Oh, also, with the whole Corona thing really kicking into high gear, the government is trying to get consumption back up to normal levels and get things like the service industry back to how it was before the penny. Unfortunately, similar to issues that we're seeing back home, restaffing is proving to be a problem in the short term. That being said, I really do hope that the secular family is out there treating workers with respect. After all, they're the ones who create all the value in the first place. Alright, peace fam.